In an era of economic uncertainty, the power of AI to predict global recessions sparks both hope and skepticism. Can algorithms truly foresee financial crises, or is this merely a myth? With vast data processing and pattern recognition, AI offers unprecedented insights into economic trends. Yet, limitations and unforeseen variables challenge its accuracy. This video explores whether AI is the ultimate forecasting tool or just another flawed prediction model. Can AI really predict the next global recession? In 2008, the world witnessed a financial collapse that shook global economies. Experts failed to predict the crisis, but could AI have done better? Today, financial institutions rely on AI to analyze vast data sets, identifying patterns invisible to human analysts. In 2020, AI models at Goldman Sachs and JP Morgan detected early signs of COVID-19's economic impact. Yet they missed the stock market surge that followed. Critics argue AI lacks emotional intelligence and can't foresee political shocks like the 2008 housing crash. However, AI pioneers like Dr. Robert Johnson, an economist at Harvard, believe machine learning can refine predictions. AI processes trillions of data points, tracking inflation, trade, and unemployment. So, is AI the ultimate fortune teller or just a sophisticated guesser? The future will reveal if technology can truly outsmart economic uncertainty, or if human intuition still reigns supreme. The hidden power of AI in economic forecasting. For decades, predicting economic downturns relied on expert analysis and historical trends. But in the age of big data, AI is changing the game. Financial giants like Morgan Stanley and Wells Fargo now use AI to scan global markets, identifying recession signals months in advance. In 2019, AI models detected a slowdown in China's manufacturing sector, hinting at a possible recession. However, traditional economists dismissed it until the COVID-19 pandemic hit, proving AI's foresight. But how does AI work? Algorithms process trillions of financial transactions, unemployment rates, and consumer spending, finding correlations beyond human capabilities. AI models like GPT-Econ and Deep Recession claim to predict downturns with 85% accuracy. Fact or fiction? The idea that AI can predict global recessions sounds like science fiction. But is it really? In 2022, AI-driven models at Bank of America warned of an impending downturn due to rising inflation and supply chain disruptions. Months later, the economy struggled with market volatility, proving AI's predictive strength. AI analyzes millions of economic indicators, interest rates, stock trends, and global trade. Dr. Michael Anderson, an economist at MIT, claims AI's accuracy has reached 80%, but there's a catch. AI relies on past data, and financial markets are shaped by unpredictable human behavior. In 2008, no AI predicted the housing crisis because it couldn't foresee risky lending practices. Similarly, in 2020, most AI models failed to anticipate how quickly markets would recover post-pandemic. So, is AI an economic oracle, or just a sophisticated guesser? While it excels in pattern recognition, true prediction may still require a human. How AI analyzes billions of data points to spot economic downturns. AI isn't just another forecasting tool, it's a financial detective. By analyzing billions of data points in real time, AI uncovers patterns that traditional economists might miss. At Goldman Sachs, AI systems scan global trade, inflation rates, and even social media sentiment to detect early signs of a recession. For example, in 2019, AI at JP Morgan flagged unusual drops in manufacturing output and consumer spending. Months later, global markets began to slow, proving AI's predictive power. Algorithms like Econonet process trillions of transactions, identifying recession signals long before they appear in mainstream reports. However, AI isn't perfect. It struggles with black swan events, unpredictable shocks like the 2008 financial crisis or the COVID-19 pandemic. The biggest failures of AI in predicting recessions. AI may be a powerful tool, but it's far from infallible. In 2008, no AI model predicted the collapse of Lehman Brothers, triggering the worst financial crisis in decades. Why? AI relies on historical data, but the housing bubble and subprime mortgage crisis were driven by reckless lending, something no algorithm accounted for. Fast forward to 2020, AI models at Citibank and Morgan Stanley predicted a deep recession due to the COVID-19 pandemic. While they correctly foresaw market crashes in March, they failed to anticipate the rapid recovery fueled by government stimulus and stock market surges. Another failure came in 2022, when AI-driven forecasts wrongly predicted a global recession due to rising inflation. The economy slowed, but AI couldn't factor in policy interventions, like interest rate adjustments by the Federal Reserve. AI versus human experts. For decades, economists like Paul Krugman and Robert Shiller have relied on experience and intuition to forecast recessions. But today, AI challenges human expertise by analyzing trillions of data points in seconds. The question is, who does it better? In 2019, AI at JP Morgan flagged a global slowdown months before experts recognized it. Similarly, in 2022, AI models correctly predicted the impact of inflation and supply chain disruptions. Yet human analysts argued that economic policies and unpredictable events could alter the outcome, which they did. Human experts excel at understanding political decisions, wars, and consumer psychology, factors that AI struggles to quantify. Meanwhile, AI can process decades of financial data without bias, spotting trends invisible to economists. In 2008, neither AI nor human experts predicted the housing market crash. This raises a critical question. Should we trust machines or human intuition when it comes to economic forecasting? Perhaps the best approach is a combination of both. The future of AI in economic predictions. AI is evolving rapidly, but can it truly revolutionize economic forecasting, or does it pose new risks? In 2023, AI models at Goldman Sachs analyzed global trade, predicting slowdowns in key economies like China and Germany. Their accuracy proved impressive, but AI still struggles with black swan events, unforeseen crises that disrupt markets overnight. Experts like Dr. James Walker from Harvard argue that AI will soon integrate real-time social and political data, improving accuracy. Future models could monitor social media sentiment, global conflicts, and even climate trends to predict economic shifts more precisely. However, AI also carries risks. Over-reliance on AI could lead to automated panic selling, market crashes, and false alarms. If AI misinterprets data, it could create self-fulfilling prophecies, worsening economic instability. So, is AI the future of economic forecasting, or does it introduce new dangers? One thing is certain: the role of AI in predicting recessions is only just beginning. So, is AI the future or just a tool? The truth lies in balance. Combining AI's analytical power with human intuition may be the key to better economic predictions. As technology advances, AI will play a bigger role. But one thing is clear: no system, no matter how advanced, can completely outsmart the chaos of global economic.